Thank you, everybody, for jumping on today. This is a very exciting webinar that we have got planned with Supavest. Now, for those of you who registered, you would have noticed that it was going to be with Lisa Thomas as the presenter. We're fortunate enough that Michael, as just said, has returned back from his holiday in Canada and was able to free up his schedule to actually be on the webinar and present today. So Lisa will still be there. She'll be in the background answering any questions perhaps, but I'll just share my screen and get going with the presentation. Right, I hope you can all see that. So this presentation today is going to be all about fractional investment. It's a product by Supavest called SAFE, and of course Michael will explain what that all means. But just a little bit of housekeeping before we get going. The regular, this is a general advice, does not constitute financial or legal advice, etc., etc. Please read that. And we are recording this presentation, and everyone who has registered will get a copy of this in the next day or two. If you have any questions, there is a Q&A box down the bottom of your screen. Please pop your question in there. If it's something that Lisa wishes to answer during the presentation, she might do so. Otherwise, we'll probably leave most of the questions to the end of the presentation, and Michael and Lisa will answer all those questions at that time. So moving on, very quick overview of NDIS Property Australia. And sorry, I didn't introduce myself. I am Debbie, the General Manager of NDIS Property Australia. For those of you who don't know who we are, who are new to the business, advisors and consultants in the SDA space. Although we are based in sunny Queensland, Brisbane, we do work across the country. Have built up a team. We're now a team of 30. Selling, marketing, consulting, very importantly, into anything to do with the SDA world, educating basically the world, the Australian world, on what SDA is all about. And we have a podcast, the SDA Housing Podcast, which we're very proud to say has got 249 episodes published to a week. So if you want to know a bit more about SDA, jump on and listen to some of our episodes. I will leave it up to Michael to introduce Supavest. But as a very quick overview, Supavest have been basically involved in a super investment, essentially. So investing in property through super. He will go into more details about how that all works, and then of course specifically on the SAFE product. I just wanted to very quickly touch on the data in the three areas that we're talking about. Supavest have currently got 3 properties for sale as fractional investment. And I don't know how familiar any of you are with the NDIA data when it comes to SDA, Specialist Disability Accommodation. But basically, we've just taken this from the most recent data that the NDIS published. What we've done is extracted the supply of enrolled SDA dwellings, in houses. So I'm excluding anything that is a group home, because we know that the NDIS has recommended these be phased out in the future. A lot of the current properties in these areas are group homes or legacy, which is a larger group home that is for 6 or more residents that will be defunded in the next few years. So I've excluded anything that we don't feel is relevant moving forward in the SDA world that is going to be attractive to participants to live in. So taking that into account, you can see that there is an undersupply of significant numbers, particularly in the Mildura area and the Sydney outer southwest area, 2 of the regions. The Renmark over in South Australia area doesn't look like it's so undersupplied, but this is only based on the demand that the NDIS has projected. And Michael is going to discuss more about the reality of the demand down there that is not being reflected in the NDIA data, which is very significant in this area. Also, just to clarify, the gaps, as I mentioned, a lot of the existing SDA enrolled properties are either existing and legacy. Existing meaning it was kind of grandfathered into the SDA world and is often not fit for purpose. Or they're group homes. So 4 residents plus, 4 residents, 5 residents is an SDA group home, 6 or more is a legacy home. And you can see that the majority, particularly in the Mildura area, are falling into these 2 categories. And so the participants living in these homes do need to or will want to move out into new build smaller dwellings as they come available. So that demand that we're seeing when we're looking at the gaps, the demand is much bigger than is kind of portrayed by the data. So that actually is what I just wanted to cover. And I'm going to hand it over to Michael Brown from Supavest.
Thanks for that. I'll just jump in and share my screen and probably just touch a little bit more before we jump into the presentation today around what Debbie was saying in relation to the Renmark and Mildura region. I guess as a business, Raymond and I come across this because we've been working in this space for 5 years. We work with a lot of providers. We're definitely solely focused around a participant-led model in the NDIS, and if people are familiar with that, it doesn't mean go and build a house wherever you want. It means where is the demand, what does the region look like, and what is the greatest results for the investor. And I know that people have probably heard, the 3 key factors in the NDIS is location, project type, and having an SDA provider. And they're the 3 things that make the great results. So we actually visited Renmark and Mildura probably 5 months ago because, again, the data didn't actually match what was on the NDIS or the NDIA data. And we had to go down and see it. So we met the SIL provider, who is the supported independent living. They provide care for all the patients or participants in the region. And we're in the process of putting together 50 houses in that region, Baronga, which is on the New South Wales side of Mildura and Renmark. And we can't even build enough because there's not enough suitable blocks of land. But typically in Australia, 1 in 8 people are disabled around the country. This region is 1 in 4. So it's highly unique, and I don't think we'll find another region like this in Australia. And again, we'll touch on that a little bit more as we go on. But I guess what we're excited to bring here today is finding out about fractional investment. And I'll, as we go through, you'll get to see what it's all about. We'll have a look at some numbers. I'll just cover off again a general disclaimer on this. I'll just get that. Again, what we're talking about today is general in nature. I encourage you to go and have a chat to a financial planner, accountant, or your experts in that field and talk about that. The next slide is actually probably more important than this one. When you are going and seeking advice, you want to understand the person or the financial planner or the business you're sitting opposite. What are their biases? Because 80% of financial planners in Australia can't talk to you about actual property, real hard property. And that's a reality. They can talk about property and share market. They can talk about, shares, all of that. That's how they get paid. And under their license, that's what they're allowed to talk about. So just understand when you're sitting in front of those people, what they are actually able to talk to you about. You want to be looking for someone that can talk to you about property, collectibles, crypto, share market, the whole range of everything that you're actually able to invest in. So just keep that in mind when you are sitting down seeking professional financial advice. Who am I? I started my life out 20 years telecommunications engineer and then moved into a few of my own businesses. I met Raymond Hempstead, the director and founder of Supavest 5 years ago, and we started a property aggregation business. In 2022, we had a couple of clients that were buying NDIS properties that were 2-part contracts, house and land outside of super. And the day before they were due to settle on the block of land, they come to us and said, hey, we want to put these inside our superannuation fund, our SMSF. So again, a couple of issues there. Do you have a self-managed super fund set up? No. You can't officially or legally you can't buy a block of land and build a house in super when you're leveraging debt. So those 2 deals went by the wayside. The thing that it did highlight to the business was at that time, early in 22, was Australians didn't have choice of how they wanted to buy and build and invest inside the most tax effective vehicle in the country, which is superannuation. So that led us on a 6-month journey to go and source funding to be able to create a single part contract solution where Supavest allow you to how we build and develop and grow wealth outside in our personal names or in trust structures or companies, do that inside the most tax effective vehicle, which is superannuation. And the NDIS product is one that's amazing with amazing returns. But again, it's got to be done right. You've got to be dealing with the experts like NDIS Property Australia who understand the reality of how to put together packages and the right location with the right SDA providers. So that's a little bit of background about me. I've been in the business since it started, and I'm now Director of Sales here, so looking after the team. Our business is growing rapidly. And we'll get into today's goal. Really, it's about learn about, register and sign up and find out more about high cash flow properties and how you can buy them now as a fractional investment. And we'll as the next slides go on, we'll have a look at some of the people that we see are using this product day to day since we launched it in November last year. So again, these are the type of people that it's impacting. So what new investors interested in entering the property market? The example I use here, my 21-year-old daughter, she wants to buy and invest in property. She's got $70,000 saved. She doesn't want to go and buy a townhouse or an apartment. So she's actually invested in one of the Safe Property shares, which is going to give her a higher return. That's an example of one. So the younger generation with smaller amounts of money. We've got individuals saving for a property or a deposit on their own property. And one of the examples we'll run through today is a couple that we're going to save 9 years and what they would end up having their money sitting in a bank as opposed to investing in fractional investments with property and where they'll be and how they can speed up their entry into their own home. Those for not prepared, don't want to invest in the stock market. Again, experienced investors that want to diversify their property portfolio. Individuals seeking monthly income. And we talk to financial planners and they talk about debt reduction. So again, how can we increase our income personally to reduce our debt? And we're seeing a lot of people recycling debt through fractional investment. Those who are looking to get more money than what's sitting in the banks at the moment. And then I suppose the one we see it the most, we deal with a lot of the older demographic and people, retirees that want high yield returns. And people that don't want to attach debt, they don't want any debt as they head into the back end of their life. So they're the sort of groups of people that are constantly looking and using and wanting to talk about safe property. What prompts your interest in investing? And that's a question everyone needs to ask themselves. Is it building savings? Is it expanding your portfolio? Is it ensuring security, creating extra income? They're the things you need to decide and work out for you on why am I investing and where do I want to go? And how am I going to get there? And through the help of Supavest and NDIS Property Australia, those two groups there can sit down and have a look at where you want to end up and run some simulations on what that would look like through multiple different ways. Let's jump into SAFE, which is what everyone's here for today. So secure asset fractional equity. So we've launched a product which is completely different to a lot of stuff in Australia. Most people would be familiar with dropping $50,000 or $100,000 into an equity fund, which is going to invest in a property or a pool of properties and getting paid a return. The biggest difference with Safe Property is it's tenants in common. There is 8 people on title. You are actually on title to that property and you own a fractional investment of it. And that is the biggest change. So you're actually buying true hard, fast real estate. I'm going to run through an example of a positively geared property under the fractional, which is a similar example. We'll see if some of that are available at the back end that we mentioned earlier around the 3 areas. So purchase price is $1.2 million for the property. Now, a 5% share would cost $60,000, $360,310 to be exact. Now, the revenue that this returns net, NDIS, it's a 3 high physical support with a carer. It returns $181,412, which means annually you're returning just over $9,000, which is paid monthly into your account, your super fund or your trust, depending on the purchasing entity you're buying it in. And that's paid monthly into there and you're growing your wealth. So that's a 5% share, okay? Now, here's an example of the couple I was mentioning earlier that was going to be saving. They're saving up for a deposit for their first home. They're going to be saving for 9 years to get a deposit, and they're saving $31,000 annually, okay? Now, as we all know, as we save money, the property market doesn't slow down. It continues to grow. So in actual fact, when you're putting money in the bank and getting your 3.5% returns, you're actually typically going backwards because you're not in the property market. Now, if we look at this same example where they've invested in safe property, and we'll have a look at a graph here on what they've done, they've actually now, by the end of year 9, through accessing safe property, end up with $476,000, which is assets that they can now sell and go towards their actual property. And to achieve the 331,000 that they initially, or 300 odd thousand they initially started out with, they can actually exit safe property at around 6.5 year mark to get into the property market because they've already earned that sort of money. So again, it's an option, and that's what I was saying earlier. There's a whole lot of different people that are using it for different reasons, but this is an example of a couple that's saving for a deposit and how we can speed up that process through the fractional investment side. I'll just move this over here because it's covering some of my stuff. There we go. So again, just touching on, if they had their money in the bank, they would have 316,000. With using safe property, they'd have 476. So they've got an uplift of, by leveraging property, or not leveraging, owning property, safe property, of $160,000. So that's a big difference over a 9-year period. And they're actually owning an asset that's increasing in value as well. And here's when I want to talk about commercial valuations, and I'm sure Deb and the team at NDIS Property Australia are familiar with this, but two products in Australia that get valued very similar to, most people will be familiar with a warehouse, how a warehouse gets valued. NDIS and rooming houses or co-living properties actually get valued as a commercial product from most of the tier 2 lenders in Australia. What does that mean? It means that effectively the purchase price of $1.2 million, once it's completed and the final commercial valuation is done, takes into consideration the rental income. It now means that that property is worth $1.625 million. So effectively, from your investment of your $60,000, you've actually got a $20,000 uplift of actual valuation and actual value in the property from one safe property share. So again, we deal in high yielding property and safe property, and this is an example of how that would be typically valued from a lender in the tier 2 space. And again, as Deb said, everyone will get a copy of this, so you'll be able to have a look through all the data and I'm just covering it off fairly quickly today to give everyone an overview, and I'm sure if there's any questions, we can come back to it later. Let's have a look at the next one, which is the older couple that are seeking a retirement income solution, and see what this looks like. So this particular couple, they have an annual income, two partners, or partner 1, partner 2, 160 and 90,000. So they've got $400,000 combined super today at that age. Now, they go onto the moneysmart.gov website, which can actually, everyone, I encourage you to go and have a look at this because it'll sort of open your eyes a little bit. If you put in your age today, when you want to retire, and your current superannuation balances for your partner or yourself, you can have up to 6 members in the super fund. It'll actually predict under the industry super fund the amount of money you're going to retire at the age you want to retire. This particular couple chose 67. So they'd actually retire on $756,000 day one of retirement, which might sound like a fair bit of money. But when we actually look at what that looks like, it actually equals $87,000, which includes the government pension. And as we see from the age of 67 all the way through to 92, the bottom dark blue section on that graph is the government pension increasing because they're actually drawing down all their money to nothing because they're using their cash at bank to live on. Now, I don't know many people that today, as a couple, can probably live on $87,000. I know my parents are doing it because they're in this position. And I guess what Supavest and NDIS Property Australia are here to say is, how do we educate Australians to change their generational wealth and their financial futures as they move forward? And through Supavest and single part contracts and safe property, it is a great way to build wealth and have property attached to that and change your long-term future in the most tax-effective vehicle in Australia. Okay. If we look at the same couple that go on the journey of safe property. So again, they're purchasing 6 safe properties at 59. At 61, they bought another one. At 62, another one. 64, another 2. And these are all cash transactions. So if we look at the age of 66, they actually have purchased $777,000 worth of property under safe. The property value, conservatively, we're saying is $902,000. The thing here is that they've actually now got a residual income which is being paid by the property income of $99,000. And as we know, every year under CPI, and especially in the NDIS space, this is CPI'd every year. So their income's actually going to continue to go up as they get older. And that's a unique thing in terms of that. Plus, the other thing here is they've got $249,000 sitting cash at bank. So again, scenario one, they're living off the cash that they've got in their super fund. Scenario two, they're using property and the income attached to the property with CPI growth to live on and have cash at bank. So I think when you compare the two, everyone would probably agree that using property, and most people I'm sure that are on here today are very property centric, and want to find out more. But this is a great opportunity to be able to build your retirement income. And whether you want to buy it outside of super like my daughter, you want to buy it in a family trust, you can buy it in any way. It's a cash transaction. So you're not leveraging any debt on that space. Again, this is just side by side comparing. So the industry super funds are on 87,000 at 67. Safe property they start on 99. Industry super fund asset value base is at 756, which is continuing to decrease as they go through. Safe property, it's 902, which is going to continue to grow in wealth as they go on with property values. They've got no funds cash at bank in industry super, where they start at with safe at 249. So again, it's highlights the variances of having an industry super fund versus taking control of your retirement through safe property. Here's some examples that we were touching on before that we're talking about. So Tamor, this property is $1.7 million. It's returning around about the 8.68 return. Again, this is going to have huge capital growth. It's in the Sydney Southwest corridor. So we've got the people that have bought these are really chasing capital growth plus income. If we move into the South Australian, which is a Renmark one, which I touched on before, this one's 11%, and I expect that will be greater because the income, I think we modelled on that's about the 181, so the it's around about the 13.48 will be paid. But again, you're getting into high yielding asset, 5% fractional opportunity. And the last one we've got at the moment, again, that's actually in Caboolture, so that's a Queensland property, and that's at 9.92. So again, we're at the moment, Supavest has got on our books 21 of these. There a couple are near completion and most of them are under construction. And it is the ability to get in fractional investment, grow your wealth, whether it's personally inside a family trust structure, you want to do some debt recycling outside, so bring some more income in to pay off some debt, or you want to hold it inside the most tax-effective vehicle in Australia. Was there any questions, Deb, on that through the chat?
We have had one question come in from Sam. Hi, Sam. Does the proposed income from these assume that the properties always have a participant in them, as they generate no income when there is no participant in them, correct? Yes, there is no income when there's no participants. Yeah, can you tell us more about, Michael, about the income assumptions?
No, that's good. And that was one I've actually got some questions up here, but we'll cover that one off to start off with. Look, you're right, Sam. The income's attached to the participants. That's where it's tied. Again, going back to the model that we follow nationally and at NDIS Property Australia is it's working in locations we know that we're going to get participants, building the right type of houses and having the right SDA attached to it. Now, the thing that I didn't mention before is Supavest owns 65% of these. So it's in our best interest because we've got a huge commitment in there to have these tenanted in the right location with the right area, because we're putting at risk 65% of our income or our ownership as well. So that's definitely a point. I think on the back of that, we might touch into the last 2 points. What happens if the participant passes away? The government pays up to 90 days. They'll pay the participants' fees whilst another person is located and found and brought into that house. And Deb's already touched on it. If there isn't any tenants in there, there's no income. So no different to anything else. I think a lot of people have had this theory and have been told that it's a guaranteed income. It's a government supported initiative around the country, but there is no guarantees in this space. It is about building it in the right location, having the right project type, and having a great SDA.
Yeah.
I might just go through top to bottom on these anyway.
Sure.
So the maximum number of investors involved in each safe property is 8. Supavest owns 65%, and we sell 5% shares as a fractional investment. Now, you can buy 5, 10, 15, 20. You can buy the whole 35%, up to you, but they are sold in 5% chunks. Do you need to be acquainted with the other investors? No. These houses are being built with or without investors. We're committed to them, and we're just filling in those. And as we fill up the houses, we bring on more projects. I think I've touched on the ownership percentage for Supavest at 65%. I think I've touched on the can I acquire more than 5%? Yes. Is there any maintenance fees? Similar to a normal property you would own, any of the costs come out, and we provide a monthly statement to each of the owners on what's been taken out, and you get paid a net fee after that. Deb can probably touch on a bit more around the NDIS space, but a lot of the NDIS expenses are covered under the participants' funding. So a lot of the gardening, maintenance, and all that sort of stuff. I guess that when we look at a project, typically we say $6,000 to $10,000 a year in running costs for insurances and audits and things like that. Outside of that, it's a standard house. Who oversees the tenant management? So we outsource that to the SDA provider, and they look after the whole of the SDA provision, collect all the funds and the reasonable rental contribution from the participants, and that's then paid to us, and then we distribute that monthly. When is it possible to sell? Anytime. Supavest in our contract get first right of refusal, so we've got the first option to actually purchase your 5% share. We are actually in the midst, and again, this was launched in November. We are actually in the midst of creating a sales trading platform where people can come in and bid on your 5% shares. But how do we get to a figure on what that might be? We get 2 valuations and we meet them in the middle. So we would get one, you would get one, and then that's what your 5% share was. So we'd either buy that or you go to market because it's a real estate that's tenants in common. What happens if the NDIS program is terminated by the government? I think this always comes up, and if you're not familiar with it, the NDIS program's actually been around in Australia for over 30 years. It was I think the last 6 years, they've actually brought in the current format. Raymond, the director of our business, was involved in DADAC and DOCS back 25 years ago, where they actually housed the top 1% of kids that were removed from families for domestic violence reasons and all that sort of stuff, one-on-one care, and that was under the NDIS program. The NDIS in its current state today was voted in by every state and territory across Australia, and it has to be voted out by every state and territory across Australia to be removed. And you've got to look at the reasons why the NDIS has been brought in to start off with. And I think Deb sort of touched on that earlier. Inappropriate accommodation, group homes, people living in aged care facilities, people in hospital beds. The government's actually, by introducing the NDIS program, is inevitably saving themselves money. It might seem like a lot of money they're paying for each participant every year, but the savings of having them in appropriate accommodation far outweighs the cost of having them in inappropriate accommodation. And some of the stuff we saw in Mildura and Renmark when we were down there, from the stories of the carers, is the people's lives changed. Like there was an example of a woman that was in an aged care facility. She was 52, on a whole lot of medication, anxiety, schizophrenia. That she was transitioned into a house, and she now lives with care. And she's a completely different woman. She's off all the medication. She's got her life back. She's not controlled. And what we see in stories around the country all the time is that people's lives, they're assimilated back into community. They're back into their own place. It's their forever homes. And it's an amazing karma investment, we sort of refer to it as. Yeah, you get some great returns, but you're actually adding a lot of value to people that need it across the country.
Yeah. Can I also just add, Michael, back on the NDIS program? What we're talking about here is the SDA program within the NDIS. The NDIS current budget is up around the 35-40 billion mark. SDA, the current payments being paid out to SDA participants is around 350 million. So it's not even 1% of the overall NDIS budget.
Yeah.
So we're talking about a really tiny piece of the pie here. 22,000 participants currently have SDA funding out of 650,000 NDIS participants. So we are talking about a really small percentage. And as Michael said, the cost savings are well recognised within the NDIS and the industry when people move in to an SDA property from where they're currently residing.
No, there's some. Again, it's an amazing program that's doing great things, and I guess we can't roll it out fast enough, to be
We
honest.
can't.
Yeah, we can't build the houses fast enough.
Mm.
I'll just touch on last two, and I think there's another question up there potentially. The tax implications for investors. The tax implications are whatever structure you're holding. So if you're holding it personally, you've got your personal tax implications at your current tax rate. Inside a family trust structure or company structure, it's at 30 cents on the dollar, or depending on how you disperse it. And then obviously inside superannuation, that's at 15 cents to retirement. Then there's tax-free in retirement and capital gains free. The last one here, can you reside in the property? The answer is no. Look, these are specifically built houses for a specifically built purpose. So no, you can't reside in those. Was there another question that we hadn't covered?
I think Lisa was going to answer this one live. A question from Erwin. What are the fees involved in selling the 5% of my share?
Yeah, so look, it's a normal real estate transaction. If it's sold to Supavest, we would just purchase it. So you would probably have some conveyancing fees in there for contract review. But outside of that, if you go to realestate.com, you're going to have some advertising fees, things like that. Yeah.
There were a couple of questions that Lisa did answer here. I just thought it might be for those who may not have seen them online since they've been answered. Who is managing the rental income distribution and annual tax statement? And Lisa's replied, a third party UW property.
Yep.
Lisa, what are you referring to there?
Yeah, that's a property management company that is going to be engaged to actually manage that side of it all.
Who is the actual SDA provider?
No.
UW Property is part of our business. So we engage the SDA provider on behalf of the safe property, or all the eight participants, or the 8 investors. And then we would distribute all the reports monthly and all of the income to the investors.
Fabulous, yeah. And also from Sam, all of these properties high physical support, or do they vary across the other categories? Fully accessible, robust, improved livability, apartment, villa, etc.
Yeah, so look, at the moment, we've got mostly high physical support. We are going to be bringing some rooming houses on shortly, so that's just another high yielding asset. Again, we're typically looking at the 8+ return on any of these sort of properties, but at the moment they are majority HPS.
Yeah, and I just want to add too on the reason HPS is the way that most properties are being constructed, and also just Sam, these are houses, not apartments or villas. High physical support properties, you can have people with IL funding or FA funding reside in these homes, and that by doing that you're covering about 90% of all SDA funded participants. Robust is kind of like a standalone category and does come with a whole lot of additional complexities with regards to the actual tenants, and how the properties need to be built and designed. So, and that's a very specific area that some people specialize in, and you do really need to have an understanding of what you're doing there. But for the majority of participants, they are either high physical support, fully accessible, IL. They can all reside in these properties. In addition, someone might have improved livability funding. They might have some kind of a disability or a condition that may be degenerative, and they may end up being in a wheelchair and being funded for FA or HPS down the track. So it actually makes sense for them with their initial IL funding to move into a high physical support home where they can age in place. So that's not going to be relevant to all participants with IL funding, but certainly a decent percentage of them, or FA participants, will fall into that. So high physical support is just a really safe option in terms of covering and having more potential tenants available.
Okay, the last question I think is Michael and I have answered it a little bit differently. So in Michael's presentation, it was like, can an investor live in the property? He answered no. And then in the chat, it was, is it possible for a participant living in one of your properties to own a 5% share? Now I answered yes. This is something that I've always, if they're a participant, then, and it's not owned by their self-managed super fund, So personally, I would expect that that's possible. But Michael, please correct me if I'm wrong.
No, you're right. Like if they're actually got funding in an SDA and they can actually, yeah, if they were to move in, they potentially could own shares of that for sure. But you're right, not inside superannuation, yeah, because it can't be deemed SMSF can't be deemed to be beneficial to the member.
We have a couple more questions popped up here. Welly, how does one get building and fixtures depreciation schedule?
Yeah, so we would be providing those because again, you can claim 5% of the total fixtures and fitting depreciation against that with your tax. Yeah.
Yeah. Sam, is it possible to own more than one 5% share? I think this was already covered. Yes, Sam,
Yeah,
you can buy
definitely.
all 7 5% shares if you wish, as many as you wish.
Yep.
And anonymous, I may have missed, what is the percentage return?
Yeah, so that on those ones there, they range from 8.68 to 13.38.
Yeah.
And again, we're putting them all around the country. I think we're building them at the moment in Queensland, Victoria, New South Australia, and WA. And again, depending on your strategy, if you want to go Tamor, you're really going for something that's a little bit less return, but you're going for capital growth because it's in that southwest region. Whereas the Renmark and the Mildura and the Caboolture certainly won't have that sort of capital growth, but the returns are higher. So again, depending on your strategy that you're looking for, where do you sit? And that's what we've got available.
Erwin has questioned, what are your average occupancy rate yearly so far for your existing SDA properties? I would say that nothing, because these properties are still under construction. This is a new venture by Supavest.
So and look, I can answer that in terms of the Renmark and the Mildura because as I said, we've got too many participants for houses. So that they will be they're 3 HPS plus carer, which again is unique. And Debbie would probably agree with majority of the time we've all talked about two participant plus a carer is in that space with 2 living areas. But the funding that they're all got down there is for 3 plus carer. So we will see full tenancy down there.
Plus the fact that there's just not the supply.
No, there's not. And you know, they're living in inappropriate accommodation right now.
And last one from Anthony. What are your costs separate to the SDA fees?
Again, I think I touched on that. Like we sort of typically see $6,000 to $10,000 out of the rent. So if it's 209 rental income, there'll be the SDA fees at 12.5%, and then there'll be $6,000 to $10,000 of cost during the year, which is your rates, your insurances, your audits, because all these properties get audited quarterly, and then any ongoing maintenance. But as I said, that the participants are funded for lawn and that any damage they do in the house is covered by them out of their funding and the SDA. And when we're talking HPS, I think Robust House, Deb touched on a little bit, very unique. Quite a lot of damage depending on the type of mental illness that the robust patients have got. But again, when we talk HPS, they're typically full wheelchair, full care. A lot of them are bed bound and things like that. So very minimal wear and tear on property.
Sam's popped up with another very interesting question. What if a participant wishes to live in it with their family and no other participant? Or are these properties specifically for multiple participants?
So these ones are all specifically for multiple participants, yeah. We have done some in the past where families moved in. Again, the family pays a rental portion, can't be done inside super. But they're living with the actual the disabled people. I think it was a disabled 2 kids they had. Yeah, it was in Victoria.
There is actually funding specific to that under something called Schedule H. But and again, it's up to the owner of the property to decide who they will accept as a tenant. And obviously these properties are being developed in very high demand areas, so the chance of getting good multi tenants with good funding is probably better than in some other areas. Which led me to I wanted to ask you, Michael and Lisa, a bit more about I guess the due diligence maybe that you would do in connecting with the providers, the SIL providers and the SDA providers for these properties, considering you are the 65% owner of them.
Yeah, look, we work very closely with the groups. As I said, we travel to Renmark and Mildura to meet the builders and to meet the SIL provider and we
also know very well.
Yeah, you do. Yeah, you
Yeah.
do. He's one of, they're one of the best in the country, and even the SDA, Bright Living Australia, they're leading the way in terms of this space and what they do in there. It's very participant led. Brad's COO is actually a high physical support patient that operates in his business, and I've met Brendan, and he's a very unique character.
Yeah.
But again, he's a high physical support, and he's assimilated back in the community, and he's working full time, and he's highly intelligent. But he's got carers 24/7. These are the type of people, but they've come from the background and the knowledge and the experience in the industry over the last 5 to 8 years of having a look at through the participant's eyes, and that's really the key thing. Like, because we can go and build a house, but if it's not fit for purpose, then we're building the wrong house.
Yeah, absolutely. That answers all of the questions that have been posed to us, plus your list. Thank you. Was there anything else that you wanted to add at all, Michael or Lisa?
Look, I'd just like to
Mind?
say thanks to NDIS Property Australia for having us on today. It's amazing. And look, it is about education. People don't know that they can buy and build property with superannuation. People don't know you can buy fractionalised investment. There are solutions out there. So I encourage you to have a look further, chat to Deb and the team. Lisa's available as well. Organise a catch up, because we're here to show you how you can grow wealth in that space, whether it be personally in a trust or inside super. There are options there, and with the asset properties like the NDIS done correctly, with great results, then that's what people are chasing. Because look, the numbers look great, but the numbers are only great if you get the three ingredients right, which is property or location, property type, and SDA. If you get any one of those wrong, you're not going to have a good experience.
Agreed. And yeah, I just want to actually add, and it's probably something I should have said at the beginning, that I'm very excited that you've now actually released this product, which is, you've had it for several months now out in the public. I remember talking to Raymond, gosh, must have been a year and a half ago, about doing part investments, that whole concept. And he said he was working on it at that point. So it obviously took quite a while to actually pull this together. But I think the model that you've done is fantastic. And I really would encourage anyone watching this today to please reach out to us. And we can definitely tell you a lot more about the different properties currently on offer. As I said, I had 3 locations listed. Obviously, they are moving because you had another one on your presentation today that in Caboolture I wasn't aware of. So obviously this is a constantly changing and evolving product offering. But we can definitely give you more information, and Supavest definitely will be able to give you all of the ins and outs, both Lisa and you've heard the team on how you can actually purchase into these really good quality investments. And as you said, Michael, it is all about getting it right. We actually say it's all about the 3Ds: the data, the design of the property, and the desirability of the property.
Yeah.
But the providers are also so important.
Definitely, yeah.
Yeah.
I'll leave you with this. This is just a bit about us for Supavest at the end. I probably should have started at the start. Lisa will kick me for this later. But anyway, look, our goal in the next 10 years is to change 100,000 lives in Australia to create generational wealth. And next year, between now and the end of the new financial year, we'll be doing 1,745 of these properties. So we are going to be out there pushing hard and educating people on what's now possible. And excited to see how many people pick up the mantle and want to have a chat and explore it.
Yeah. Actually, one more thing I did think of, I just want to add. I mean, you might have noticed that the cost of these properties is quite up there, and we're looking at, the 1.2, 1.5, 1.6 million for the entire cost of the property. This is what we are now seeing as a good price for a good SDA property, given that the cheap areas are now all oversupplied. We've learnt what works, what doesn't, and where the demand is in really expensive areas. And you need to build a really high quality, very desirable, well-designed product. And it is going to cost you that money. And for more and more people, that is now out of reach to be able to purchase the entire property. So this is just such a fantastic alternative option.
Look, I might just add my little two bobs worth, because I've been sitting here quite quietly learning actually a lot from Michael. It's been fantastic, but and from you, Deb. It's been wonderful. But look, just it's the smartest product. As Michael touched on, it only launched in November, and I think the first 4 properties that we had available, half were actually sold to mortgage brokers and financial advisors that were actually, you know, we were talking to. They're like, this is the smartest thing I've ever seen, and very, very excited. So there's a lot of interest in this, and yeah, they are selling very quickly. So yeah, definitely get onto it.
Great to hear. Well, I think we'll leave it there. So thank you both very much, Michael and Lisa, for joining us today. Thanks to everyone who has jumped on. And yeah, we'll leave it there.
Thank you so much.
See you later.
Bye.
Yeah. Bye.